much, ladies and gentlemen. We've got one very interesting session on smart alternatives for a hedged approach to generating alpha. In today's volatile market landscape, generating alpha requires a little more than traditional strategies. It demands a thoughtful approach that balances risk and return. And so we have in this session our eminent speaker, Mr. Puneet Sharma, the fund manager and CEO of WhitespaceAlpha, who's going to dive into how smart alternative investments, particularly in cash and derivatives, offer a hedge solution for consistent alpha generation. So these strategies are not only designed to maximize returns, but also incorporate sophisticated risk management techniques to safeguard against market downturns. Mr. Puneet's extensive experience from spearheading advanced investment strategies at Whitespace Fund to his previous role at PwC India, where he specialized in business valuation and derivatives, brings a unique perspective on how these funds can pursue high risk-adjusted returns while maintaining a strategic hedge against potential market risks. So let us all welcome Mr. Puneet Sharma as he unpacks the power of alternative investments in today's dynamic markets. Ladies and gentlemen, please welcome Mr. Puneet Sharma, Fund Manager and CEO of WhitespaceAlpha. Warm welcome to you, sir.
Thank you very much. Good afternoon, everybody. Thank you so much for that introduction. Really appreciate it. We spoke about a number of factors since morning today, including we spoke about the extent that India is expected to grow over the next maybe around 5 to 10 years, the extreme bullishness that everybody has about that. We spoke about quant and how that brings in a significant amount of benefit to investors. How about we combine all of that into a single entity? How about we generate alpha, which is the elusive alpha that everybody is chasing here, and deliver it using a combination of a very low-risk strategy, highly dependent upon quantitative analysis, but also banking on the number of growth years that the Indian economy is going to have. So can you do the presentation? Right. So I know I'm the last speaker before lunch, so I'm the only person holding you off from probably a full appetite. So bear with me for a little bit. Before we get started, I just wanted to check with you. You guys are invested into mutual funds as well, I'm assuming, or would have historically invested. How many mutual funds do you think over the past, let's say, 3 years have delivered more than their benchmark returns? Anybody wants to take a stab at what would be the ratio of funds delivering more than their benchmark returns? Not even quantifying the alpha that they would have delivered. Anything above benchmark? Sorry, I couldn't hear. 10% would have delivered over their benchmark. This is mutual funds. Well, okay, without trying to ruin the surprise. So spread across number of different industries parameters. So blue chip, large cap, mid cap, what you have. On an average, we are looking at about 33% of the funds delivering more than their benchmark. Now, I don't know if you guys are surprised with this number, or at least I was when I read about this in the ET article. So I find it a really surprising aspect of our industry overall, where a lot of the funds over a large enough period, which was 3 years in this case, the data that you have in front of the screen, a large number of the funds are actually underperforming the benchmark, about 2/3 of them. Now, this data is not mine. This is from an ET article. But the point here to note is that a lot of these funds will not be underperforming on a year-on-year basis, but over a 3-year period, you would expect that a lot of these funds should deliver alpha over their benchmarks. But coming down to it, would you expect your investments to deliver alpha on a year-on-year basis? Each year, should your investment deliver an alpha? I'm assuming everybody is going to say yes. Why wouldn't you say yes to such a question, right? Now let's break it down further. What if we tell you that there is a fund which delivers alpha on a month-on-month basis? I mean, that's the objective of WhitespaceAlpha. That's the fund that I head. We've been delivering a month-on-month alpha for the past 5 years. We've been running our equity plus fund. So that's the whole genesis of the fund. We want to invest into the Nifty 50, but deliver an alpha on a month-on-month basis. I'll try and explain how we do that, but obviously that's a much larger discussion. I don't want to do it over a session which is just holding you off from lunch. So we'll make it quick, but I'll be available to discuss it in detail if anybody wants to have a more detailed discussion about it. So without further ado, let me get into the details of this. So WhitespaceAlpha, we're trying to reduce the amount of risk that we have in the overall portfolio, but at the same time deliver an alpha over and above whatever the benchmark return for us is for our equity plus fund, that's Nifty 50. As you see, what we're trying to do is to keep our risk extremely low while delivering more than what you would have otherwise anticipated over a security market line like this. A different set of investment will yield you a different set of risk that you're going to take in the market, and obviously you would expect it to deliver a consequent amount of return as well. Now, how we do it is that we have a very market neutral strategy for generating alpha returns. What we do in this is that we are very low correlation to the equity market. That doesn't mean that we are not correlated or not reflecting the Nifty 50 returns. We reflect the Nifty 50 returns, but beyond that, on a month-on-month basis when we are delivering the alpha, that alpha has nothing to do with what's happening in the equity market. If the equity market is going up 10% or going down 5%, there is still an alpha to be made in the market. That's what we're trying to achieve out of all of this. The entire strategy that has been devised is aimed toward delivering that alpha on a monthly basis. We take long positions, we take short positions. That is how you develop a market neutral strategy in the first place. You are going to analyze a large number of companies. The gentleman from ICICI Security talked about covering about 600 securities with a team of about 30 analysts. Sonam just mentioned about having a coverage of about 500 companies as well through our quant strategies. That's a similar kind of a thing that we do at our fund as well, where we are looking at a large number of companies, regularly analyzing what's the position. But for us, the universe is limited to the F&O space, so derivative space. Right, so analyzing all of those companies on a continuous basis rather than on an annual or a weekly or a monthly basis. And we obviously focus on specific factors as well. When we are developing a market neutral strategy, you would want to look at value, you would want to look at momentum, growth, obviously momentum being a big factor as well. All of these parameters eventually should lead to an opportunity that you're going to exploit in the market to deliver that alpha. Therefore, it requires a continuous monitoring as well and reacting to whatever is happening in the market at a very breakneck speed. Now, this I think is the critical portion of whatever that we are doing at the fund that differentiates us from a lot of the other funds out there. Succinctly put, not all market neutral strategies, not all AIFs, not all PMSs are made the same. It's very true for what we are doing here as well. At a very top level, we are looking into data on a continuous basis, that is live feed from NSE, looking at every movement that's happening in each stock price. That's the very granular data-driven approach, something very similar to what a quant-driven strategy would be. But quant is more focused on taking a long position in the market. Here, it is also about the short position that you're going to take. It's again, so when you're looking at data, you also need to have that capability to analyze that data. You need to cover a large spectrum of the industries available. You need to cover every available data point that you're going to take a position or potentially can take a position in. So that becomes very critical in the entire analysis. And in a normal market neutral strategy, what ends up happening is that you would probably assign ranks to various companies. You will go overweight on a particular company or you will go underweight on a company depending upon what your analysis is throwing out as a indication. Now, the speed of analysis when you are looking at a market on a real-time basis is extremely essential. You need to identify these opportunities when you're looking at the market data in real time to identify where is the opportunity to make that alpha. So the analysis has to be extremely quick. The second more important aspect there is that the execution based on that analysis, if when your analysis says, all right, let's take a position in Reliance right now, but you need to have that ability to take that analysis down to its intended conclusion by taking that position in Reliance, be it long, be it short, whatever it may be. Again, so the rapid rebalancing of portfolio, nimbleness in the high volatility, that's the high volatility period where you would typically find the maximum number of opportunities to generate a slightly additional amount of alpha. Hedging for optimal management of exposures and risks. This is where a lot of the funds that probably do similar strategies struggle. That's where you need to have a very clear idea of what you're going to do with the positions that you have taken. If you're going to take positions in the derivative market, carry them overnight, you need to have a hedged position. If you're going to take a naked position overnight, that's probably asking for trouble. So hedging, again, a very critical aspect of it, something that the model, wherever that you're developing it into a market neutral strategy, has to be a very deep focus area of any strategy that's being developed. These are all the things that you need to do. Something that you also need to avoid is taking bets or positions in the market that you originally did not intend to take. When you're depending very heavily on the data, few drawbacks usually occur that data, the authenticity of that data or the accuracy of the data is always questionable. You always need to verify whatever data that you are receiving. Has it been vetted? Is there a decimal error? Is there a comma error in the data somewhere? Those are the kind of issues that we have seen historically take massive amounts of, create massive amount of problem for various funds. So they may lead to positions that you actually did not intend to take. So that's something that you need to be very careful about when you're developing certain strategies like these. Again, so concentration risk is again something that is very critical in managing a very market neutral strategy, where if you go very heavy on a particular sector and that sector is impacted by news coming out, let's say over a weekend, that concentration can lead to issues in the overall performance of the fund that you would want to avoid. So concentration risk is again something that's becoming a more important parameter as a fund would grow. And when you are trying to reduce your concentration, you would end up reducing a number of positions. That's always a balance between the amount of risk that you're carrying with the concentration and the cost or probably potential profit that you're not going to make anymore because you have reduced your position. So that's always a balance that you need to account for as well. Just as an example, I have a few data points from the fund's performance over the past 5 years. So as you can see in the fund, so our fund has seen performance over the past 5 years. VIX, which is an indication of the volatility in the market or the expected movement of the Nifty 50 index in this case, has moved quite dramatically. In the COVID period, it was hitting 64 figures. March of 2020 sees a 64 figure. In that period also, the market neutral strategy that we are deploying at WhitespaceAlpha delivered a 1.14% alpha. Similarly, across a number of other periods when VIX is low, VIX is high, the fund or the strategy that you're developing should be focused at generating that alpha. That's what we have delivered at Whitespace as well. Again, it could be a period like March of 2020 when the market is down 24%. Has the fund delivered an alpha? Our fund has. We have tested out models into various stressful situations for the market scenarios, eventualities that you would eventually face, right? So in the market. So a market neutral strategy really works when you're taking a long and a short position and are very quick to react to all of these situations. I'm gonna just take a quick pause. Anybody has any questions? Because this is a data heavy slide, I just wanted to take a short pause there. Right, okay, we'll move forward. So just a very brief overview about the fund. I know I've already discussed more about the fund in the previous slides as well, but we run a very market neutral strategy. It is a very low volatility, so looking at generating a very steady amount of alpha on a month-on-month basis over the underlying in our equity fund, that being Nifty 50. Consistent incremental returns, when you add monthly returns for over a long period of time, let's say 3-year period, they add, and the compounding really takes it to a different level in terms of the final outcome that you're looking for. Again, Kamal was referencing taking out the decision making or a bias from data analysis. That's again something that we are very particular about at the fund. None of the decisions that are taken on the trading floor are driven by biases. We do not hold on to position hoping that some position will get better or hoping that the position will deliver a little more profit. If the model indicates that we need to square of this position, book a loss, or square of the position, book a profit. Both decisions are done, executed immediately. Position sizing, again, I mean, that's more relevant to a more detailed discussion, but the positions that we end up taking in the fund, be it long or short, they are sized so optimally that in case you need to execute the trade quickly, they can be done very quickly as well, and anything goes wrong in that particular position shouldn't really hurt the fund too much. We invest very heavily into R&D in developing this entire model, in having our data, the IT systems robust enough to handle all the data analysis that goes on. Strong operating processes is something that we have implemented extremely well at the fund as well. And obviously our team comes with a large experience as well into various different aspects of the fund management side. On the strategy side, our model really is a combination of 3 different strategies. It's index modeling, statistical modeling, and momentum strategies. Again, I don't want to make it into a mathematical discussion here, so I'm going to avoid talking more about it. Just one point that I wanted to make here is the Sharpe ratio of our strategy is close to 2.15. That basically means the strategy or the model delivers about 2.15 times the risk-free rate in terms of the returns that it generates. So, right. As I promised, it's a very short and sweet presentation. Nothing to hold you back from lunch or me from lunch. So, yeah, any questions, I'm happy to take them on.
Your reference link is the Nifty 50.
Right, sir.
Most of your investments are in mid caps.
No. Sorry, let me clarify then. So in our Nifty 50 return, Nifty 50 strategy or the equity plus fund, our underlying investment is purely into Nifty 50 stocks. In the same ratio, we are replicating Nifty 50. Essentially, it's like an ETF, but on top of that, through our other positions that we take, we are delivering an alpha on a month-on-month basis.
Thank you.
Right. In the debt plus fund, the underlying investments are into GSECs. Primarily into GSEC, delivering that's about 7% return that we have from the GSECs right now. The additional return is from the model or the strategy side. That's the alpha that we are referencing. Yes, sir.
Yeah, the equity plus returns, how many years CAGR is it?
This is over a period of 5 years.
Okay.
Yeah. Right, sir. Yeah.
So is the tax implication different?
So the good thing is it's a Cat 3 AIF, so there is no pass-through taxation. All the tax calculation burden is on me. But yes, you're right. There is F&O trading. That's all categorized as business income. There is investment into equity side, which is capital, which is categorized as capital gains.
Okay.
So it's a combination of both here. Yes, sir. 100% of the investment goes into long portfolio. And using that as margin capital, we are able to trade in the F&O side.
I see. Okay.
But implicit of tax.
Sorry?
The returns are net of tax or these include the taxes?
Vicky, can you please confirm these are excluding taxes, pre-tax? No. These are, I think, pre-tax returns. We can give you the net numbers in case that is relevant.
Taxation is huge. It goes into the...
So that changes on a year on a... In the long term, I would assume Nifty 50 to deliver somewhere between 12 to 15%. Assuming that the ratio between business income and LTCG, because we hold equity for a very long time, I don't think we have sold equity for a period now, it should come down to eventually somewhere between around maybe about, or let's say blended tax rate should be in the range of about 20 to 23 odd %. There are expenses as well which get allocated to both and all that, so it gets complicated. So unfortunately, no straightforward answer, but yeah, blended tax rate around 20 to 23 odd %. Sorry? So long-term capital gain is 12.5% plus surcharge plus cess, which is 14.95%. The business income is 30% plus surcharge plus cess, which is 39%. So a ratio, yeah, I mean, depending upon each year, it could vary a little bit. But we'll realize the long-term capital when we realize. So it's a combination. So we do, there are 6 options available to us. I shouldn't call them options, but there are 6 provisions available to me. I can buy futures, sell futures. I can buy call options. I can sell call options. I can buy put options. I can sell put options. The strategy indicates that I need to take different positions at different points of time, but it's all 6 positions taken during the cycle of a month, yes. It's concluded every month. It's concluded every month. At the end of the month, we square off all of our open positions, and we only have cash balance in our account. This is only on the derivative side. The cash, the long positions in the underlying, they remain as is, right? Then we start the cycle once again in the next month where, yeah, month-on-month basis. That is the intention, right? So the intention is to generate that alpha on a month-on-month basis from the entire strategy. And we have delivered that for the past 5 years on a month-on-month basis.
I understand that cash margin is
Sorry,
required.
I can't locate you, sir. Yes, sir, please.
Cash margin is required for derivative trading. So where do we get that from? Because I understand that you mentioned that the portfolio is 100% long.
It's a long position. It's a partial mix of actual cash stock buy and some portion into futures. That portion contributes towards my cash margin requirement.
So say if I put in 1 crore, so you won't be buying stocks for worth 1 crore. A part of it will be kept as cash, which will be used as cash margin.
Right.
Okay.
But the exposure on against that 1 crore will be for 100% of the equity market. Right. Yes, sir.
During COVID period, right? What is the maximum drawdown you had?
I'm going to break this down into 2 different parts. So our underlying portfolio, we are very cognizant of the fact that India is a very long-term play. It is a long play that we are also banking on, as a number of other speakers have also spoken about. So in the long term, the Indian equity market will deliver somewhere between 12 to 15% return on a CAGR basis, depending upon who you ask, how bullish or bearish they are on the Indian market. With that kind of a conviction, we are not hedging our portfolio on the underlying side. So it's a nifty 50 replication. So if we speak alpha alone, which is performance of the fund over and above the nifty 50, our drawdown would have been, I think, about close to 73 basis point in a month. That's the max that we would have had.
That was even during the COVID period when I think...
Actually, COVID period, we were positive.
You were positive?
Yes.
Wow.
All during that period. I think we had only 1 or 2 months where we have actually had a negative alpha generated in a month. So.
Okay. Okay. Thank you.
In the long only portfolio? On the derivative side, it's very variable.
Okay.
It changes very dramatically depending upon all the data analysis which happens, and we are very quick to react.
Okay.
So
you do take the multiple exposure in the derivatives when, like, if asset is 100,
Yeah.
so you take it exposure in the derivative value at 200, 300?
we don't go that high.
Okay.
By default, the SEBI limitation is we can't go above 2x.
Okay.
So 2 times. We can't
So
go.
you do reach the 2x?
No, we don't reach anywhere close to that. We do not reach anywhere close to 1x also in the derivative side.
Got it.
Right, so any last questions? All right, thank you so much. It was a pleasure talking to all of you. Thank you so much.